Hey guys, welcome back. The stock market is shrinking, and if you're a passive investor, it might be time to start worrying.
I gotta get out of here! Calm down, get a hold of yourself!
SpaceX, ByteDance, Chick-fil-A, all of these are companies that have chosen to remain private rather than undergoing a public IPO. And they're not alone.
I don't feel so good.
30 years ago in 1996, there were 7,300 publicly traded companies within the US. Today, that number sits at only 4,300, a drop of 40%. Meanwhile, the number of companies backed by private equity has grown from 1,900 to 11,200. With passive investors relying on a strategy of buying every single company in the market, how will that strategy perform as more and more companies in the market can't be bought? Today, I want to talk about that and also go through some recent comments by Jamie Dimon, the CEO of JP Morgan, talking about this phenomenon of this disappearing stock market. Why is it happening and how can it be prevented? First of all, what's the difference between a publicly traded company and a private company? A publicly traded company is one whose shares are listed on a public stock exchange, like the New York Stock Exchange, the Nasdaq, or even the London Stock Exchange. That means that its shares have a large amount of liquidity because there are lots of people buying and selling the shares at any given moment in time. So you can offload or buy shares without a jump in the share price pretty easily. But a private company is one who has shares, but they're not listed on any exchange, which means they don't have to follow the rules of exchanges. But it's much harder to buy and sell a private company's shares because there's no given stock price that the company's shares are worth at any given moment in time, like there is in the public stock market where you can just check what Apple's stock price is. There's no such thing for the private market. In addition to that, you have to find a buyer and or seller, contact them directly and get the deal approved by the company itself. That means there's a lot more friction when you're doing a private equity deal. Now, traditionally, the goal of any startup or private company is to IPO one day. It allows the founders and staff to basically get a giant cash payout for all of the hard work that they've put in to grow the company to that stage. Think Mark Zuckerberg when he launched the IPO of Facebook and became the youngest ever self-made billionaire at the age of 23.
$1 million isn't cool. You know what's cool? You?
$1 billion.
But that's no longer the only exit route that founders can take. By selling part of or all of their businesses to private equity funds, founders can effectively cash out of their business, but also avoid the kind of regulatory requirements and disclosure required by a public IPO. Many companies are frightened that by disclosing information that is key to their businesses, they may basically benefit one of their rivals by disclosing proprietary information. And that is a particular concern in the age of tech companies, which have most of their market value based on ideas rather than actual physical assets. Personally though, I do think that the disclosure requirements required for public IPOs are a good thing for the general health of the stock market. As an individual stockholder, how can you buy shares in a business without knowing the business through and through? Without the business providing that for you on paper, as well as all of the risks, it becomes a really hard sell to become a co-owner in the business, which is what is effectively happening by you buying shares. In fact, studies have shown that when requirements are loosened for IPO disclosure, there are more IPOs, but they tend to be from companies of low quality that are effectively duping the public into buying their shares by not disclosing the adequate level of risk in the company. With all that said, what did Jamie Dimon, one of Wall Street's most iconic bank CEOs, have to say about the state of public markets in the United States? It's worth noting that as the head of JP Morgan, his bank tends to make a lot of money from IPOs by advising the private companies that are going public. So the trend downwards in IPOs is not necessarily a good thing for his business. So bear that in mind when looking at his statements. He said with regards to the decline that the trend is serious and we need to consider as a society whether this is the outcome we want for the public stock market. And in general, I tend to agree with him. As I said previously, private markets are a lot more opaque than public markets, so a lot less information is available to investors. But it's not only investors, it's also regulators who can't get as much information about whether businesses are complying with the rules, and analysts as well who can't easily value businesses because they don't have as much information. In addition to that, there are concerns that because individual investors or the public cannot invest into these private companies and share in the profits, they may actually become less likely to vote for business-friendly policies or capitalism in general. Dimon laid a lot of the blame at the feet of quarterly financial reporting for public companies. Although he did say that financial reporting, when done in a detailed and disciplined manner, can be an extremely positive thing for a company, CEOs are often under a huge amount of pressure to hit financial targets every 3 months so that the market is happy. And if they don't hit those targets, they can come under a huge amount of criticism and even potentially lose their jobs. Just watch the recent interview by the Starbucks CEO with Jim Cramer, where he basically got absolutely roasted.
You said it's not business as usual, and I want to make a point here, sir. You are still expanding as if it is business as usual. You had, for instance, on the quarter, you talked about opening stores in Honduras and Ecuador. Is it not time to pause, sir, and figure out what's really going wrong and spend a deep dive and making it so that this decline in comp store numbers does not continue? Because it is perilous to the actual existential existence of Starbucks.
There's a reason why other countries like the UK, for example, changed quarterly reporting requirements into annual ones to prevent more of a focus on short-term goals rather than long-term goals. He stated that because public companies are under such pressure to hit their financial goals every 3 months, it leads to a lot of them kind of being tempted to fudge or stretch the numbers in order to hit those goals. For example, they may do sales at the end of a quarter in order to finally stretch the revenue to the level expected by the market, or they might be tempted to cut expensive investments that will pay off in the long run and be well worth it because the market might not like that initial spend. Think about the AI investments done by Meta or Google within the last few years, where the market has reacted very badly to increased spend, but it's most likely that these investments will pay off very well in the future. Dimon also slammed annual shareholder meetings, which he said do not have their original purpose and need to be replaced by something more effective. He effectively said they have devolved into meetings for special interest groups to effectively push their agendas, which aren't really related to the day-to-day business or financial goals for the company, things that shareholders actually care about, or the vast majority of shareholders at least. Take the recent annual shareholder meeting for Apple, for example. They had a bunch of measures which the shareholders had to vote on that effectively were trying to get the business to disclose more information on its diversity within the company, whether it was developing AI ethically, whether the company had a pay gap on gender or race, for example, and so on. Things that the company doesn't necessarily need to disclose, and something that most shareholders do not want the business to disclose for obvious reasons, and they were all voted down soundly and resoundingly. But ultimately, it represented a huge amount of time wasted by the company in order to advise its shareholders to vote against these things, for shareholders to vote on them instead of more important things, and so on. It's not only less private companies going public via IPO, but it's also more public companies going private by being bought out by private equity groups. And I do agree with Jamie Dimon here that a large part of that is because it's easier to have long-term outperformance and business goals when you're not having to focus on the short-term desires and wants of shareholders in quarterly reports. I like companies that ignore the noise when it comes to quarterly financial reports and the share price dropping massively after some unexpected news. For example, when Meta announced that they would spend more than expected on AI capex, the stock price dropped massively, and I bought more shares because I knew that investment previously has done very well for Meta, and I thought it would do the same again, as AI will produce more revenue in the future. And temporary spend is not that big a deal in my opinion. But if more public companies are going private, then what does it mean for passive investors who are trying to get exposure to the whole market so they can get a return that is equivalent to the average of the stock market in general? Well, it really depends. If you believe that the majority of companies going private tend to be high quality companies, then it's probably pretty bad for a passive investment strategy because you're only going to be exposed to public companies and your returns will go down in the long term. But if you believe it's only average companies that are going private, then it probably won't have any difference in the long run. Imagine if the previous generation of big tech companies had never gone public and had just stayed as private companies. The absolute return of something like the S&P 500 or the public stock market in general would have been pretty atrocious over the last couple of decades compared to the reality of what we got. And there are some signs the next generation of tech companies are refusing to go public and staying private. Think SpaceX, OpenAI, or TikTok's owner ByteDance, for example, and so on. This doesn't bode very well for a passive investment strategy because you rely on getting exposure to a few quality companies by buying all of them effectively. And I think it adds more weight to the argument that having an active investment strategy over the next decade or so will probably outperform a passive one as long as you're investing in high quality companies. So let me know what you guys think about the death or the shrinkage of the public stock market. Let me know if you think it's real or if it will eventually reverse and the trend will go back to what it normally is. If you want to hear more about why I think the European tech market is in decline, please watch this video here. But if you did enjoy this video, please leave me a like and subscribe, and I'll see you guys next time.